The stock market just hit its 23rd record high this year. By almost every macroeconomic measure, we are living through one of the richest moments in history. Home prices are at an all-time high, and the collective net worth of Americans has never been larger. But there is a massive disconnect between the data and the people. Consumer sentiment has plummeted to its lowest level ever recorded, dropping below the lows of the 2008 financial crisis. Right now, people feel worse about their financial situation than they did when the world was paralyzed by pandemic lockdowns. You can see the contradiction in the average American 401k. The balance recently hit a record high of over $160,000. Yet in that same year, a record number of people were raiding those exact accounts. About 6% of all savers cashed out early, willing to pay the tax penalty just to access the cash, a rate that has tripled since the pandemic. These aren't discretionary withdrawals. 36% were to avoid foreclosure or eviction, while another 31% were driven by medical expenses. Relying on average metrics hides these localized economic catastrophes. We can't understand the current economy until we stop looking at it as a monolith and start breaking it down by class. This boom is being fueled by massive asset inflation. Since 2020, the market has risen over 120%, and home prices have climbed about 55%. But those gains don't fall on everyone like rain. Of the 134 million U.S. households, the ownership class, the wealthiest 10%, controls the vast majority of these assets. This group owns 87% of all stocks, while the bottom 90% splits the remaining 13%. The dollar figures make this gap impossible to ignore. In a typical year with a 16% market return, the bottom half of the country sees a paper gain of about $2,000. That same return hands the top 10% over $96,000. The national economic boom is essentially just asset inflation flowing directly into the specific accounts of the ownership class. If you don't own the assets, the record highs are just headlines you scroll past on the way to work. At the other end of the spectrum is the bottom 50. More than a quarter of users now use these installments for groceries, financing their weekly food run just to get through the week. The personal savings rate has dropped to 2.6%. But when you look closer at the bottom half of the country, that rate is actually negative. For 65 million households, the safety net is gone. They are spending more than they bring in after taxes, sinking deeper into a financial deficit every single month. Economists used to cite the K-shaped economy, but data shows an E-shaped economy, 3 tiers living completely different lives. The top bar, the ownership class, holds 68% of the wealth. The bottom bar, 67 million households fighting for survival, holds just 2.5%, sinking under debt. Finally, there is the middle bar, the middle 40%. These are the households with just a thin layer of breathing room left, but they can feel it getting thinner. Data shows their struggle. There is a pronounced migration away from premium retail toward discount and warehouse stores as the middle class survives the squeeze. This downward tilt of the middle class completes the shape. They aren't part of the ownership boom. They are quietly slipping toward the bottom. This is why the headlines and your bank account never seem to line up. The economy doesn't exist as a monolith. We are living in the same country, but we are participating in 3 completely different Americas.